Good morning, everyone. And first, let me thank President Citrux and for organizing all this. I think it was about time that we engage in a deep discussion on this topic. It comes to a critical moment for the destiny of the euro and the opportunity that history is giving us to make euro strong, resilient, a safe harbor in the world of finance. We should not miss this opportunity, and that's why I think this event is very timely. So, most people link Euro's adoption with the launch of euro banknotes and coins. Although the euro was introduced for accounting purpose in 1999, it did not feel like our money until we started paying in euro cash 3 years later, making it a tangible symbol of a united Europe. A strong currency goes hand in hand with strong payment system. Although less visible than banknotes and coins, payment infrastructure form the plumbing of the financial system, which are key to monetary and financial integration. Retail and wholesale payments are thus central to our central bank tasks. We as a central bank issue cash and banks reserve, and also operate payment system to ensure secure, risk-free and European transactions, preserving the economic stability and our monetary sovereignty. Building on this reliable base, private sector firms offer their own solution without their customers having to worry about the money they use. 1 euro is 1 euro because private money can be always converted to cash, and because financial transaction can be settled in central bank money, the only risk-free asset. So today I want to focus on how we can make our currency future-proof and enhance the integration, competitiveness, and resilience of European payments in the digital era. As digital payments and online commerce expand, the role of cash as a universal payment solution is declining. We thus risk being left without a European solution that allows us to pay throughout the euro area in all situations. To maintain the central role of cash, we need to complement it with its digital equivalent, the digital euro. This step is crucial to modernize public money and overcome payment market segmentation by offering an infrastructure and an acceptance network which private providers can leverage to expand and innovate on a European scale. Ultimately, a digital euro will enhance digital payments options for consumers and increase the competitiveness of European providers. The situation is different for the wholesale financial transaction, as we already offer settlement in digital central bank money and do not face the same dependencies. However, market participants expect tokenization and distributed ledger technology to transform financial transactions by enabling assets to be issued or represented as a digital tokens. Therefore, we are expanding efforts to settle DLT-based transactions in central bank money to avoid the risk of other settlement assets being used, such as US dollar-based stablecoins, which would reintroduce credit risk, fragmentation, and dependence on non-European solutions. We are progressing on the retail and wholesale front in parallel, so that Europe retains its own sovereign money for the digital era. In the world of the late French economist Michel Ayeta, money is not just a technical device, it's an essential institution. Let me first discuss the rationale for the digital euro and its benefit. Currently, cash is the sole sovereign payment method across the euro area. It offers Europeans a convenient, secure, and universally accepted way to pay. Cash also ensures resilience, serving as a reliable fallback during crises like cyber attacks or power outages. This is why we strongly remain committed to cash. However, with digital payments on the rise and more than a third of our retail transactions occurring online, cash is no longer sufficient to cover all payment situations. In value terms, cash payments made up only 24% of the day-to-day payments in the euro area last year. Without a genuine European payment solution that works across the euro area, we rely heavily on foreign providers. Currently, nearly 2/3 of the euro area cash-based transactions are processed by international card schemes, while 13 euro area countries depend entirely on them. And where national card schemes exist, they require co-badging with the international card scheme for payments in other euro area countries. Moreover, mobile apps and the e-payment solution are dominated by foreign solutions like PayPal, Apple Pay, or Alipay. This solution aims to further expand. PayPal has just announced that it will start enabling contactless payment in German stores using MasterCard technology. Looking ahead, our dependence could soon expand to foreign stablecoins, 99% of which are dollar-denominated in terms of total value. As a result, European payments face three significant challenges. The first challenge is ensuring our strategic autonomy and monetary sovereignty. Our over-reliance on foreign payment providers make us dependent on the kindness of the strangers at the time of heightened geopolitical tension. I trust that this risk is well understood in the country of President de Gaulle. There is no true sovereignty without sovereignty money. As my dear colleague Bank de France Governor François Villeroy de Galhau has remarked, this is as true in the 21st century as it was in the past. Second, we should simply ask ourselves why there is no European-based international card scheme. I would say it's because we suffer from a lack of competitiveness and innovation. European payment service providers struggle to compete on a European level, let alone globally. For instance, the cost of investing in a European-wide acceptance network has often discouraged European payment service providers from offering pan-European card payment solution. These failures are costly. Dominance by non-European providers stifle competition, rising costs for merchants and consumers. European banks lose fees when payments go through international card scheme. They lose both fees and data to apps like Apple Pay or PayPal. And widespread use of dollar-based stablecoin could lead banks to lose fees, data, and deposit. Third, Europeans face a poor user experience by juggling multiple payment solutions for different needs. Despite the Euro 25 years legacy, we lack a digital payment solution available across the euro area. The digital euro would tackle these challenges head-on. It would make payments more convenient, extending the benefits of cash in the digital realm. Because of its legal tender status, it would be accepted for all digital payments throughout the euro area. It would also be available offline, ensuring cash-like privacy and enabling payments without a network connection. In essence, it would be a simple and safe digital payments option available for all payments needs. In fact, one simple reason for introducing the digital euro is that people want it. Already now, surveys show that close to half of the respondents would likely be using the digital euro. Launching the digital euro would also ensure we retain control over our financial future by reducing our dependency on foreign providers. This would shield European merchants from excessive fees and allow European banks to maintain customers' relationship while being remunerated for distributing the digital euro. Additionally, it would curb the use of foreign stable coins for retail payments in the euro area. Moreover, the digital euro would be based on a public-private partnership that would enable private initiatives to scale up across the EU. Domestic card solution could co-badge with the digital euro and cover those transactions behind their current reach. At the same time, banks' wallet and internet banking could integrate the digital euro as an alternative way to pay that is accepted throughout the euro area and support both contactless and QR code-based payments. Open standard for the digital euro would support cost-effective standardization, allowing private providers to launch new products and innovation on a European scale. Last October, we issued a call for expression of interest in innovation partnership for the digital euro. Some 70 merchants, fintech companies, startups, banks, and other payment service providers, including 4 from France, have now joined us in exploring the potential of the digital euro to drive innovation. One of the areas where we are exploring is the use of conditional payments, such as making payments depending on successful delivery of goods or services. The positive feedback from participants in the Pioneer work stream has led us to extend the exercise until the end of June. It was supposed to close in May. In July, we will release a report on this innovation partnership, which will also include the technical information shared with the participant, enabling the entire market to replicate these activities. This partnership demonstrates that the digital euro success hinges on collaboration. In recent years, we have engaged extensively with market stakeholders, gathering inputs from consumers, merchants, banks, and payment service providers. We want to make sure we address everyone's needs and perspective and build a robust payment solution and platform that will benefit all Europeans. Let me now briefly turn to the wholesale transaction, where technology holds tremendous potential transformation. Currently, we at the ECB facilitate transaction between financial institutions through our target services. T2 processes over 90% of large payments, while target T2S handles securities transaction. These services have allowed us to enhance the efficiency and the integration of post-traded platforms in Europe, and we continue to improve them. In 2023, we extended T2 operating times. We are about to launch a consultation on the need to further extend them. In a month's time, we will also launch the European Collateral Management System, which will provide an integrated framework for handling collateral in the euro area. And in October 2027, we will shorten the settlement cycle from 2 days to 1. However, beyond such incremental improvements, emerging technologies such as DLT and tokenization have the potential to bring about a steep change in the wholesale markets. They represent a fundamentally new way of operating by allowing assets to be issued or represented in a digital token form, which would enable trading, settlement, and custody on a single platform available 24/7, 365 days a year. European banks are already active in the DLT space, with over 60% exploring or using it. A new business model could emerge to automate conditional transaction. Ultimately, these technologies could reduce the cost and the barrier to access capital markets and create an opportunity to establish an integrated European digital capital market. This digital capital market union would contribute to better channeling our saving into productive uses, boost Europe's innovative potential, and help European markets become an hub for DLT-based financial services. The availability of central bank money for settling transactions with these new technologies is crucial for two reasons. First, it preserves credit risk First, it prevents credit risk and fragmentation associated with the use of alternative settlement assets like stablecoins. Second, it is seen by the market as essential for adopting new technologies. Last year, the Eurosystem explored using DLT for settling wholesale transactions in central bank money, testing 3 solutions to ensure interoperability with market DLT platform. The results were highly promising, with 60 industry participants settling real transactions in central bank money or conducting experiments with mock transactions. So we are planning to provide a solution to settle DLT-based transactions in central bank money in the short run. This will be in production solution. But we are also exploring a more integrated long-term solution addressing the risk that DLT application fragmentation and the lack of interoperability could hinder the development of a liquid DLT-based markets in Europe. One way to achieve this would be to move toward a shared ledger, a programmable platform bringing together token version of central bank money, commercial bank money, and other assets. Another option could be to the development of a coordinated ecosystem of fully interoperable technical solution. Also, here, collaboration with the public and market stakeholder will be crucial. Let me close and conclude. The move toward a digital euro, a new technology in a wholesale transaction is key for Europe. Embracing this innovation will boost monetary sovereignty, competitiveness, and financial system integration. The digital euro will offer a secure, reliable, and universally accepted digital payment solution that complements cash, reducing our reliance on foreign providers. Using central bank money for DLT-based transaction will unify the digital asset market, driving innovation and business opportunities. However, we will only succeed in this transformative era if we work together. We must bring together all stakeholders, public and private, national and Europeans, to craft solutions that reflect the diverse needs and perspectives of all Europeans. Thank you for your attention.